Let's just start off with the recent batch of data that we've been getting out of the U.S. JOLTS opening surprising to the downside yesterday. ISM manufacturing also surprising to the downside. What does this tell you about how the U.S. economy is evolving in terms of also how it impacts those interest rate expectations for the Fed?
Yeah, thanks, Joumanna. Yeah, the recent bit of data over the past week or so has definitely been on the weaker side. And we've seen that reflected in the yields dropping, as you mentioned, about 30 basis points over the past few days. However, I think that the market generally tends to anticipate and over-anticipate some of these moves, and the real proof of this is going to have to come from core inflation. And unfortunately for the Fed, that remains very high. Now, Powell has been on the dovish side for quite some time. And so the market has responded to that and recognizes that they're looking to cut as quickly as they can. With the labor market weakening, it seems like that would indicate that they could potentially go a little bit sooner. But I think when you really look at it, the developed central banks are relying on their models and really saying, oh, we expect inflation to come off because of labor market weakness, because of these other factors. These are the same models that told them that it was going to be transitory in 2021. You're supposed to learn from your mistakes, but they're again seem to be really undershooting inflation and expecting it to come off way before they really have the hard data.
Yeah, and it's a bit of a problem. I mean, let's turn to the ECB now as well. I know that perhaps for this Thursday, the question is less about are they going to cut because that's priced in. But key to the investment community is what signal they give about the coming interest rate path. And it feels now that the calculus has had to change for the ECB as well because of those upside surprises to inflation.
Yeah, absolutely. And the last week's prints and services inflation were much stronger than expected. And now the ECB, as they've done fairly regularly in the past year and a half, they're stuck with the commitments that they've made previously, and they're going to have to cut rates tomorrow, as is very well expected, even though it doesn't really seem like that's the optimal policy. And I think if they had a do-over, they probably would prefer to wait and see for a little bit longer. And the economists like Philip and the other members are looking at it and saying, hey, July, we could still cut again in July. But realistically, that's not a possibility, and it's very, very unlikely for that to happen. And more, it looks like this might be a one and done from the ECB as they wait for much longer to see really sustained decline in inflation before cutting again.
Wow, one and done would be major. Actually, how do you think the euro would respond to that? And how do you think traders are positioned? Do you think there is an anticipation that the ECB could only cut once?
I think traders over the past couple of years have learned that the central banks are primarily data driven. And if the data doesn't support additional cuts, the ECB will end up kind of retracing and saying, yeah, we're not going to cut anymore. And so I think what we'll see tomorrow is that while the projections are going to be lower for inflation, it does mean that Lagarde will not be committing to any further cuts, and she will try to reiterate the meeting by meeting policy. And I think, with how much we've priced out from the Fed and the ECB already in the first half of the year, I don't think it's unreasonable to expect that we can continue to price out more of those cuts. The real question ends up being, are we actually in restrictive territory sufficiently to get inflation down quickly?